Good morning, ladies and gentlemen. This is Brad Matheny. Today is March 3rd, and I wanted to go over this message from Ron Richardson. Ron, I really appreciate this. I can understand some of your concern regarding this chart. We need to the best advice I have for you is anything can happen. I did a video a couple months back that discussed population, psychological trends, and the reality is that people don't naturally become overly pessimistic. Normally, some sort of a crisis event or some sort of measured pessimistic trend may occur. But in most of the examples we have of any type of crisis event taking place, the 1929 top, or the crisis through the World War II, which really was a fairly deep crisis, stagnated the markets for almost 16 years, if my memory serves me. Then we went through another period in the early 70s, late 60s, early 70s, of a period of stagnation. Then we went through an expansion period, and then we went through the 2000 dot-com bubble burst, and then the 9/11 attacks, and then eventually the global financial crisis. So understand that there's some catalyst that normally causes some crisis event. Now, what I will tell you right now, all of you, is that I believe a couple of things have set up in the market. Number one, we've got a fairly strong global economy. Overall, globally, we've pumped a lot of money into the economy since the 2008, 2009 crisis, global financial crisis. Things have been global. Let me rephrase. Let me start over. We pumped a lot of money into the markets, trillions and trillions and trillions of dollars throughout the world, to be able to support the economy after the global financial crisis, which was a big one. Okay, the intent here is now we have an engine globally where nations that were prior to, let's call it 2003 or 1997 to 2003, nations that were just getting kind of their feet on the ground now have turned into, potential economic engines. So we have a lot of nations throughout the world that have come from very meager economic expectations to more moderate expectations. In the process, we've also acquired quite a bit of debt. The money that's been printed, the zero interest rates, and the global attempt to spark some sort of an inflation trend has really prompted a global credit debt issue that is unwinding right now. It started to unwind about a year, probably about 8 months after COVID. It actually happened in China about 8 months, 10 months before COVID. And what we're going through, again, is a unwinding event. Now, the unwinding event can either be orderly or disorderly. In my opinion, so far, it's been relatively orderly. And yes, we do have the potential for the markets to come back down to potentially these COVID high levels. So you can see here, in fact, let me come over here and get one more chart right here. So you can see that the U.S. and global markets could revert back down to these COVID high levels. This is my U.S. to global index weekly chart. So in reality, we could see the U.S. markets move back down to this 40% area, which is the COVID high pre-support prior to Joe Biden getting elected. This is the Joe Biden-Trump election time frame right here. We are in an early stage presidential election cycle, which means it will probably stay relatively flat, meaning in this 40% to maybe 80, 85% range, staying fairly flat for the next 12 to 15 plus months. Same thing with the global markets. Global markets could move back down to COVID lows. They were very close to COVID lows. And if they break these COVID lows, then global markets may move back down to the 2015-16 price range, which would be a fairly big unwinding for the global markets. I think the U.S. markets are going to try to hold above this level, and if they get below this level, then we have a whole host of support right over here in this area roughly at plus 15, 16%, somewhere around there. And I will touch on this going into the weekend's videos. But again, Richard, your comment was, hi, Brad, are your models flashing an event of significant drawdown of 20%? Here is the implied bias based on the 6 MEOs suggesting a drawdown of around 25% in the next 5 months by the precognitive forecasts. I will suggest this, that there are a lot of models that do predict a downward trend. The Fed is going to move efficiently to try to curb inflation. I believe the bottom in the housing market, the support for the U.S. real estate market and global real estate is starting to crumble, and I believe we're going to likely see some sort of a downturn there. We could see REITs and other assets move down potentially another 15 or 20%, but understand from where we're at, let me come over here to a chart, and this is an ES chart. Let me go to an SPY chart and go to weekly, and understand that a 15 to 20% move from where we're at currently, which is right over here. So let's go off of these highs. Would probably put us right down around this level. That's 12%. So let's go down to 25. There's 24.89. That'll put us at the 301 area. And we'll take a look back over here, and that'll put us right in the mid-COVID area. So theoretically, another 25% downside move would put us right into the late 2019 price range based on what you're proposing. My opinion is the unwinding of the global assets is going to create a unique scenario. So hypothetically, this is what you're talking about, coming down another 25%. And my belief is that the global markets are going to unwind in a moderately orderly format. The central banks realize they can move interest rates down if things start to collapse. They can move into zero interest again. They can provide stimulus just like the Chinese central bank is doing and Europe had been doing for many years. And they can attempt to mitigate any downside risks fairly quickly. I believe the unwinding of excess credit and debt is going to take place on a global scale, whereas the global markets, for example, at-risk countries throughout the world are going to have to unwind excesses related to ongoing liabilities, bond liabilities, debt and credit market excesses, which may make the U.S. market seem unreasonably attractive compared to global markets. If the global markets continue to unwind, which I believe is happening, and there are risk factors involved, I believe the U.S. markets are going to look, like I said, unreasonably attractive. Think of it as what I call the shiniest pile of poop theory, which is when you're digging through trash, trying to find the best piece of trash you can find, to eat or to, hypothetically, I'm not saying I would eat trash, but it's my theory. When the world goes to crap, hypothetically, and you want to try to put your money to work, what you're going to try to do is find the best piece of crap you can find. Something that the markets are going to hold up well. There's going to be some intrinsic value. There's going to be a chance at some ROI. And I believe the U.S. markets are uniquely positioned. And I believe the U.S. dollar will strengthen probably over the next 12 to 15 months before the presidential election. I believe it's going to catch a lot of people off guard simply because they believe that the Fed raising interest rates the way they have is going to prompt a massive collapse in the market. The dot-com bubble burst was a U.S.-centric type of collapse of assets. The 9/11 attacks were a U.S.-centric type of global financial event. The 2008, 9, 10 global financial crisis was a U.S.-centric based event. The global crisis, as I'm calling it right now, is a world event. It is less U.S.-centric, and I want you to understand that. When interest rates were very, very low, global nations and companies and individuals and governments loaded up on cheap U.S. debt and world debt. It became very easy to borrow U.S. dollars at 0.75 or 1.5%. And issue very cheap bonds. They loaded up on this debt so that they could go ahead and take advantage of it. They could borrow U.S. dollars, which were strengthening, and they could turn around and maybe make 15, 20, 25% off of that cheap money that they were borrowing, and go ahead and execute a business plan, borrowing more money, hypothetically borrow $100 billion, make 25% off of it, and then turn around and pay back the $100 million or roll it into a new bond at 1.75% and just keep doing it. Well, the COVID disruption totally blew that carry trade, I call it, out of the water. All of a sudden, bonds are now requiring 8, 10, 12%, and commodity prices have skyrocketed. Consumers are slowing down. Sales are slowing down. You can't borrow at 8, 8.5%. when your cost of product has gone up 50, 60, 100%, and your sales have dropped off 25, 30%, what happens then is instead of making 25% off of a very cheap 1.5 or 2% bond transaction, now essentially you're losing 15, 20% off of that same bond transaction because the conditions aren't allowing you to profit the way they were. So what ends up happening now, these countries are trapped in hundreds of billions of dollars of low interest bond debt that they're going to have to resolve throughout a tightening economy. I believe, if I can come back to here and try to show you, again, this is your post, Ron Richardson, and do I believe a 25% collapse is likely? At this point, I would say probably not more than 20, 25% chance. I believe we're going to stagnate above this 3,500 area on this chart and attempt to flag out into 2024, where we will see a bigger upside trend as the markets settle. I see a downside risk as being very moderate right now, probably only 20, 25%. Now that could change because the markets can flip if there's some U.S.-centric catalyst event. Now, what I wanted to try to show you was back over here, and let's go to monthly. Try to drag this into view for you. So this is an SPY chart, and what I'm going to try to do is shrink all of this out to 2008, 2009, and I want to try to highlight. This is one of the charts that I show periodically. These are a lot of Gann angles. All of these comments are what my MENT rotational modeling system was doing. Obviously, this is my website. Bring to front. And what I want to point out here is this. Spread this out. And from the peak of the COVID crisis to the bottom was approximately 119 points. You see right there, 119 points on the SPY. If I clone this and drag this over here from this peak roughly to the bottom, and let me do this differently. Let me do it with a box so you can see. So from the peak of the COVID time frame to the bottom, and we'll make this good and dark with a dark red. And if I were to clone this and drag it, if I can, up to the peak of the 2021 time frame, carrying across this area, let me drag this out here, you can see how we've mirrored the downward trend. we have mirrored the COVID collapse through this unwinding cycle. So what we have done here on the S&P is we have essentially taken the exact same 100% roughly measured downside move as the COVID collapse. This was a global event measured in price expectations based as 2019 levels. And we have taken the exact same correction to the downside, 100% downside move. Could we move further? Yes, we certainly could. Are we near a bottom? I believe we are for two primary factors. And that is these trend lines here, this blue trend line here, and this dashed yellow trend line right here, carrying forward all the way out, produce an upward sloping trend cycle right here. I'm going to try to move them to the front. Visual order to front. Visual order to front. And again, this is what's great about TradingView is you can do all of this drawing. I know my charts look all cluttered and crazy, but understand there's a method to my madness, including these little arcs and circles. So when we take a look here, here's our support level. The bottom occurred back in October, perfectly at this support level. We are now flagging out. We've broken above this downward sloping channel. We need to see a new wave extension to the upside. I do strongly believe that we will stay within this range. You see this Fibonacci level here. You can I'm trying to highlight it. It's basically from this 444 level to this low of 373. I believe we are going to stay within mostly this range throughout the end of 2023 and then move into an upside cycle in 2024. I believe this is a wave one, so you can see we have an A, B, then we have a rotation back over here to highs, then possibly a minor little C, and then possibly an E wave up. We'll have to go down here to the weekly chart, which will show us even more detail. And you can see from these lows, we have an A, B, C, possible D, possible E, up to this 435, 440 area that I've been calling. You can see right here, this circle is pretty much right there. That's where I've been calling as a high since back before the end of 2022. You can see the lines I've been drawing. I've been pointing to this 433, 435 area as a potential peak. I think this is where we're going to be come March, April of 2023. And then I believe we're going to roll into a sideways trend, which will see us move back down into here, possibly to 400, 405 in this area. And then we're going to roll towards July, August, September into a Q3, Q4 rally phase. I do not believe we're going to see too much downside. Now, the other thing I wanted to point out was this chart, which is the U.S. Valuations Trend Index. This is a monthly chart. You can see from back over here, the 2018 lows, then back over here, the 2014 lows, and then back over here, the 2008-9 lows. We have continually moved higher high, higher low, higher high, higher low, higher high, higher low, higher high, and then a bit of a lower low through this contraction phase. This was right before an election cycle. Remember, we were moving into an election cycle here, and this is why we need to be aware of election cycles. Right in this area was an election cycle. Right in 2020 was an election cycle. Right over in here. If I do the math right, I believe 2012 was an election cycle right in this area. And then we would have had 2016 would have been election year right over in this area. So understand that in an election year, we can see a downward trend. I believe we're going to hold support up in this area, staying above this low. And I believe we're going to resolve to the upside near the end of 2023. It won't get to new highs. The S&P or the SPY will not get to new highs in 2023, in my opinion. It will in 2024, 25, 26, and then peak somewhere in 27, 28, 29. But I do not believe that we have much more of a downside risk. I believe that even if we did have a downside risk, we would be looking at the pre-COVID levels as support. So again, 2017, 2018, 2019 would likely become very strong support and it would probably be a deep V type of correction if it were to happen around some sort of a catalyst. I still don't see the catalyst yet. And then lastly, I want to point out this cycles evaluation. This is the 2008 collapse. This is the COVID collapse right here. You can see it taking place right here. And now we're consolidating downward near this trend. We've seen a moderate unwinding of price. We've seen a move from a 240% peak down to 150%. We've seen a sufficient U.S. unwinding. As long as the shiniest pile of poop theory predicates that the U.S. market and the U.S. dollar is going to maintain strength compared to weakness in global markets and credit asset risk in global markets, then I believe the U.S. market will benefit from, let's call it, unseen price support. Capital will continue to move into U.S. assets simply because the U.S. economy is stronger, more resilient, more capable, and better positioned to handle the debt and credit event that is continuing to unwind compared to more at-risk global economies. So again, I hope this helps. Remember, we are in a very dynamic market trend, and my analysis could change. So pay attention to what I'm doing. Come to my website. Remember, come back over here to MENT.com. Learn about what I do. And like I said, come down and join the Expert Growth membership. It's very inexpensive for what I'm trying to teach you. And remember, the MENT rotational modeling system is doing quite well. Let me come over here and find it right here. One of the primary reasons you want to join the Expert Growth system is because of this modeling system that I run for members. This is the MENT rotational modeling system. It runs on the SPY. It beats the SPY handily. There are periods of drawdown. I'm not going to lie. It's not a, constantly 100% system, but it's a very slow, stable system. It does not require you to make, maybe 2 to 4 trades, 5 trades a year, maybe. Sometimes in these longer upward trends, there's just almost no trades. We're just staying in a long trade. But understand that we are nearing all-time highs. We're seeing volatility. I think we have another 6, 7, 8 months of sideways volatility. And then maybe around August, September, October, we start moving into an upward trend. And that's going to be right before the election, based on anticipation of a potential change. Actually, that's a year before the election. We're going to see some real growth maybe in 2024. That's my opinion, but we will see how it plays out. Okay, guys, I hope this helps. Bye.